the paper markets were the tail on the dog, but the tail constantly wagged the dog because they would overwhelm the physical markets with paper. The problem now is they've done it for so long and to such a grand extent that now there's a question whether these paper contracts are going to be able to deliver. And the answer I think you're going to find in the next month to 3 months, we're going to find out that no, the paper markets are not a substitute for real physical because they have to deliver real physical that does not exist.
One paragraph. China, the world's largest silver refiner, is restricting exports and has announced that starting in 2026, all silver exports will require individual government licenses, effectively giving Beijing full control over every ounce leaving the country. This move classifies silver as a resource of national interest, signaling a strategic shift towards state-managed.
Imagine waking up to find that the world's gold and silver markets have gone silent, not because prices crashed, but because no one can deliver the metal anymore. Bill Holter says that scenario isn't far-fetched. It's the logical end of years of manipulation in the paper markets. For decades, massive institutions have written contracts promising far more gold and silver than actually exist. Those paper promises have controlled prices, masking the real scarcity underneath. But now that illusion is wearing thin. According to Holter, the next few months could expose the gap between paper and physical markets. The question isn't whether the contracts will fail, but when. Futures and options only work as long as there's metal to back them up, and that metal is rapidly disappearing. The danger goes beyond investors losing faith. Gold is a monetary asset, but silver is also an industrial lifeline. It's in electronics, solar panels, and weapon systems. Each Tomahawk missile, Holter points out, uses roughly 500 ounces of silver. If the market can't deliver, entire industries could stall. And if that happens, the financial fallout could be brutal. A delivery crisis in gold or silver wouldn't just shake confidence, it could freeze the system altogether. Banks, brokers, and insurers would suddenly be holding worthless paper. Holter's advice is blunt. Keep at least part of your wealth in physical metal, outside the reach of digital systems and financial middlemen. Because once the music stops, only those holding the real thing will still be in the game. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
The market is, the bottom line is all of the futures, options, paper products, etc., they're all based off of the physical metal in the first place anyway. That's why they're called derivatives. They're derivatives of the actual product. There's not as much concern. There's concern. If gold were to go, if gold doesn't deliver, the system dies anyway. But if gold doesn't deliver, it's not a direct effect on production, if you will. Silver is used in so many different applications, whether it be industrial, technological, medicinal. I just did an interview and was talking about every time they shoot a Tomahawk missile, there goes a monster box. You can't make a Tomahawk missile without roughly 500 ounces of silver. So silver will have profound ramifications to the real world, to the real economy. Now, that said, if silver goes failure to deliver or gold goes failure to deliver, you're stuck in the casino because the casino will close. And when the casino closes, and we've talked about this, for the last, year and a half, maybe even 2 years, we've talked about the great taking. Once the casino closes and banks and brokers and insurance companies start going belly up, they're going to take your capital with them. And that's why it's so important to get your capital out of the system into something, gold and silver, that cannot bankrupt, and in a place where it can't be taken from you. Right. Well, going back to visit the late 2019 episode, that was just before COVID, and the repo rates spiked to 10%, and that the Fed was having to put $100+ billion into that market every single night so it could clear. Then conveniently along came COVID, and two things happened. The real economy worldwide was definitely stunted or shut down, whatever you want to call it. There was less demand for credit because of COVID, and it allowed central banks all over the world to flood the markets with liquidity. Problem solved. Not solved, but the can was kicked down the road. Here we are again. We're nowhere near where we were in October of 2019, but the overnight rates are starting to move higher again. It's a concern and should be watched. Again, everything, whether it be the real economy, production, consumption, transit, and also the financial world, the financial economy, everything runs on credit. If credit gets disrupted or credit ceases anywhere, it'll be a shock that will it'll shut the whole system down. Yeah, I would just say welcome to the party. And next I would say we have interest rates still at basically generational lows. I mean, we're not where we were 3 or 4 years ago. We're not at 0% rates, but rates are extremely low. There's no risk premium in interest rates at all. So brokers and banks, they understand that the likelihood long-term, 5 years, 10 years, longer than that, the likelihood is that rates are going to go higher, not lower. And they also understand that there's going to have to be another mass printing, whether they call it QE or not, it doesn't matter. But there's going to be another global mass printing. And the problem with that is that debases the currencies, and that lowers the value of the unbacked currencies. If the values are lower, then you got to give more of dollars or euros or yen or whatever for that same ounce of gold or the same ounce of silver. So I think they're looking at it pragmatically and saying, yeah, the day of buying and holding bonds is over, and that's why they're recommending half of that bond position be liquidated and put into gold. The only problem with that is if everybody did that, you'd have gold at probably, who knows, $2 million an ounce. Just, pick a number, but it's going to be super, super high.
Andy Schectman points out that most of the world's silver still comes from just a few key regions: Mexico, Peru, and Canada. But in recent years, China has been moving fast to lock up that supply. It's been offering miners nearly twice the price Western buyers pay for semi-refined silver and mine concentrate, the raw material produced before refining. China then ships it home for processing, boosting its control over both production and refining. Even as one of the top silver producers, it's acting like a nation preparing for scarcity, while Western countries, particularly the United States, remain dangerously reliant on imports. Schectman says this isn't just about silver, it's about strategy. China is building deepwater ports in Peru and investing in logistics that give it long-term control over commodity flows. The world is watching a shift from paper-based Western markets to a model rooted in physical ownership of resources. He adds that China's next move raises the stakes even higher. Starting in 2026, every ounce of silver leaving its borders will need government approval. By labeling silver a resource of national interest, Beijing has effectively brought it under state control, a move that could reshape global supply dynamics for years to come. Let's get back to the interview.
Yeah, most of our silver comes from Mexico, Peru, and Canada. And it's interesting, I mentioned Mexico and Peru. The Chinese are going right to those miners and saying, we'll pay double what the West will. We want your doré, which are the crudely refined bars. We want your concentrate, which is the byproduct mining sludge. Right. And we'll pay double. We'll send it back and refine it ourselves. Now, this is coming from the second largest producer of silver on the planet. David Morgan will tell you, when he went there to tour the mines, China told him, we're number one, we're not number two. Whatever they are, they're massive producers of it, and they're flying all around the world to buy stuff and refine it themselves when we almost entirely need silver. When we need silver, it's almost entirely coming from other countries. We are reliant upon it. on other countries, and that is a fragile supply chain. It's not a good thing. At the same time, you got China building deep water seaports in Peru and trying to build their infrastructure. I mean, there is a game of chess going on right now that people really aren't seeing, and that game of chess is who can secure all of the world's commodities. Shh, don't tell, do it quietly, don't freak everyone out, but this is a battle of gaining supremacy on the commodities of the world. It's shifting from paper promises by the West into who's got the goods around the globe. They do export, but they are now limiting exports as of, I don't know, within the next month or two. Any silver that leaves the country has to apply for a permit with the government. And they were big exporters. They're not going to export quite the same way, because I think it's in response to the moves that the U.S. is making. It's in response to the realization that they have a real advantage in having the supplies that they do, and why make it any easier for the U.S. when we're doing the things that we are doing in terms of tariffs and in terms of trade restrictions and sword rattling. Saber rattling. I just think that they're smart to do that, and I think it will be a growing trend. But they just did publicly announce that they are going to limit drastically, and they have also characterized it as a matter of national security as well. This is going to be a trend that you will see, a nationalistic trend, I think, as time goes on, as the prices go higher. China, the world's largest silver refiner, is restricting exports and has announced that starting in 2026, all silver exports will require individual government licenses, effectively giving Beijing full control over every ounce leaving the country. This move classifies silver as a resource of national interest, signaling a strategic shift towards state-managed supply. And then at the same time, you got the U.S. adding it to the critical mineral list. This is no coincidence, and it's a battle for the world's supplies of things that are critical to infrastructure, critical to military, critical to a world that is digital. It is, you need silver to transmit electricity across long distances. You need silver, and I think that's for semiconductors and electric vehicles and defense and solar panels and on and on. I think that's becoming clear. There is a huge spike in warrants on the Shanghai Futures Exchange, and like almost over 100 tons or near 100 tons, but that he believes that and there's also a massive amount of silver that Russia is no longer exporting that hasn't been accounted for. A huge amount, and there's no one knows where it is, of gold that they used to export as far as recently as 2024, and that they believe, along with Russia issuing a yuan-denominated bond next month, that they are going to move it to the Shanghai Metals Exchange vault in Hong Kong, their new vault in Hong Kong. Remember, I've talked to you about how they're building vaults all around the place, but to take gold out of China has to go to Hong Kong. That they're moving it there to act as a repo facility, and so to act as a repo facility that will be an alternative to the U.S. dollar. Now, these guys are cutting edge, Eric and Vince, and I wouldn't discount what they're saying. So, any way you look at it, and when I say gold, I mean silver too, but gold has a more prominent role in the workings of the monetary system. Silver's just been viewed as critical, and and by the people who understand it, they know they need it. But both Vince and Eric think that gold, or a gold-denominated bond, will come out of Hong Kong as part of a new offshore repo collateral system, and that will be a massive blow to the U.S. Treasury market.
A quiet reordering is underway in the world of precious metals, and the message is impossible to ignore. Gold has reasserted its role as the steady benchmark of value, weathering every attempt to sideline it. While silver is no longer the volatile cousin trailing behind, it's becoming the real disruptor. Structural imbalances between supply and demand have reached a point where price suppression looks less like strategy and more like denial. Central banks, institutions, and even seasoned investors are beginning to adapt, shifting away from the comfort of traditional allocations and back toward tangible assets that history has never fully replaced. The widening cracks in the paper markets, the growing recognition of gold as portfolio insurance, and silver's potential to rewrite its own historical limits all point to a broader awakening in global finance. This isn't about chasing momentum anymore. It's about survival in a system where paper promises keep losing credibility. If trust in fiat-based markets keeps eroding and physical ownership becomes the new measure of security, how long before gold and silver stop being just investments and start acting as the foundation of a new financial order? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.